how are you? Rower Ari Randy here again. We are now going to have our last session of the accounting for financial decision and control course of the MBA at Blackboard Global University. And we will be wrapping up this course to address the final aspects that are important to convey. So I am going to share the PowerPoint that is being viewed right now from this pulse. So, what have we been doing? Well, in this last session, we have been talking about financial planning. In the last session, we were specifically reviewing what the cash flow cycle is. We are looking at why it is. Everything related to planning and budgeting a company's finances can be absolutely very important. We were looking at the mismatches or discrepancies that can occur in this regard, and we examined what the principle of equality is, which basically seeks to be a balance between the type of asset and type of liability and serves as a guide and order when deciding on financing. We also looked at an alternative way to understand a company's balance sheet and how it evolves, which is through the operational need for funds, which differentiates between current assets and the spontaneous liability, and also the working capital, which is that part of long-term liabilities that finances the difference between current assets and current liabilities. In essence, it finances the working capital of a company. So let's move on to the final concepts of this course to start wrapping this up. Now, what is happening? What is happening is that one of the fundamental topics, as you have seen, especially in this last session, has to do with analyzing how things are coming forward. Because one thing is to understand the past. When we looked at the financial statements, how these results are put together, the balance sheet, the cash flow statement, and some appendices. It's one thing, but it's another thing entirely to truly understand, right, how someone who comes to this gets ahead, the projection, and for that, we have to do it with numbers, right? It's not just theoretical. It's not merely conceptual. Okay, and when we incorporate the numbers, well, we have to estimate something, right? So, for example, if I want to estimate how much the accounts receivable of a company will be in the next period, what would I have to do? For example, say here, what do accounts receivable depend on? On sales. And what can I use? I can use the accounts receivable turnover ratio, for example. Well, in that case, if we know that credit sales are going to increase by 300 and the accounts receivable turnover is 6 times, basically what would happen if that holds true is that accounts receivable would increase by $50,000, 50 million, whatever it is. So it is very typical or normal for us to have a variable to estimate, and for that variable, we will use a base variable that affects it. For example, sales in the case of accounts receivable based on a certain reason or financial relationship derived from history or the past. Now, regarding financial planning specifically, well, the most traditional approach is to create a cash budget. That is to say, it is not enough to make a projection of sales or a projection of the income statement. They are necessary, but by no means sufficient. So, in this regard, as you can see here, we are going to separate this budget into 3 main areas. is the operational budget here. What is the operational budget? Well, we list all operational income and expenses or those of the business. Income includes what we sell for cash and what we collect from accounts receivable, while operational expenses include salary payments, payments to suppliers, and other payments, right? This also covers administrative and sales expenses, including taxes. So, the difference between income and operational income is the budget or operational flow. Right? Now, how often do we do this? It depends on the type of business. At least one should always have at least one monthly cycle, right? Well, businesses operate on a monthly basis, so there are many variables. So at least monthly. In other cases, businesses that have a lot of cash flow might do it weekly, and businesses with many activities there probably do it even daily. However, monthly is still the standard, and many times bi-weekly or weekly is also quite common to maintain close control over cash. Now, after the operational budget, what comes next? The investment and divestment budget comes next, which refers to the purchase of assets and the sale of assets, and there may also be a financing budget. But it is usually operations, investment, and then financing. Here, in the case of financing, it is divided into two parts: long-term financing and dividends. For example, when a company takes on long-term debt or pays off debt, it pays interest, pays principal, and makes withdrawals, as well as short-term financing. So always start with the operational aspects, revenues and operational income, the investments for fixed assets, and finally the financing. But here, financing is divided into two parts: long-term financing and dividends, and short-term financing. So, the fine-tuning, if I need, for example, to use a line of credit, or if I need to make a timely payment, right? Or, for example, I can sell a financial asset, a money market right, that I have to obtain that final cash balance. So, normally companies will have an initial cash balance, and that initial cash balance, it will be added to the cash flows that occur over a period of time to ultimately arrive at the final balance that the company has. Now, then, ultimately, we are going to have a certain approach to budgeting where companies will typically have specific goals and objectives, a plan, and a long-term strategy. They are going to start making sales forecasts, determining the product mix, and also what the short-term sales forecasts are, that is, a period of 1 year or less. And here, more specific aspects will start to appear, such as standards related to production, materials, sales, marketing, research, and everything that is more financial, for example, financial control policies, specific budgeting, etc. Why? To be able to use all this information to arrive at the projected financial statement. It is worth saying that we are capable of projecting cash flows, the income statement, and the balance sheet. The company there, except clearly, usually arrives at a projection of the income statement. However, if we want to have a complete view, we will, of course, need to project the cash flow and also project the balances. In this way, we will have a comprehensive or 360-degree projection that will be very important for having a complete view of what the company's business is. Now, having said all this, and now, to start wrapping things up, We have a couple of exercises here that are interesting and important for you to review. The first from the company Roar that talks about this concept of the principle of equality. And so that you can see it calmly, here we are presented with a company that has a projection for its cash flows for the next quarter, Super have its deficit, and based on those flows, they present us with 5 financing alternatives, each with different characteristics, and then they ask us to calculate things like permanent financing, maximum temporary financing, evaluate these 5 alternatives, and see which one to choose. So there is the development for you to analyze more thoroughly and look at, and give us a clear view of how this should be considered. And then there is an exercise that is the last one presented, which is a very comprehensive exercise called Manufacturing of Ideals. It is a case where, starting from an initial balance and certain projections, we are presented with the need to create a monthly cash budget, a financial needs plan to determine whether we need short-term financing, a projected income statement for the first half of the year, and a pro forma or projected balance sheet as of June 30th. So, in this case, they provide us with an initial balance sheet of the company, its asset structures and liability structures. They give us the most important aspect of any projection, which is always the sales projection. Here, in this case, 1 million per semester, starting in January with 100,000 and ending in June with 250,000. Why could there be that distribution? Well, it could be because it is a business, seasonal, or simply because a company that is growing also needs to consider how we are going to collect payments. Selling is one thing, and collecting is another. Here it is mentioned that we will do distribution, but as often happens, there will be a percentage, in this case, 5% of sales, that we will not collect, which will be uncollectible. The monthly payments we have to make for sales and the profits we generate require an estimation of production costs and expenses, simplified of course, because the idea is not to go into too much detail, but rather to ensure we understand the structure of this projection. After the purchase of materials, how we buy materials and how we pay for them, the taxes that accrue but are paid later. After the movement of fixed assets, the CAPEX touches on assets we plan to buy and how we are going to pay for them, how we are going to finance them with long-term loans. Here, minimum cash balances are important for many companies. The minimum cash balance is something equal to or close to zero. Here, it is not the case. Based on the movements of the phases, certain minimums are set. We cannot be below that minimum, which is a safety balance, so to speak. Also, how we take or use lines of credit in the company as a way to also play around with those that are easy or mismatched. And finally, the interest on short-term loans from the line of credit. So, with all this, a projection is made. Here we did not have accounts receivable. So basically, we are going to project sales in a single table. We will project the collections we will be making, the collectibility, the balance of accounts receivable, then how the materials are paid. And with that, along with all the assumptions, this budget is put together, which is separated here, as we mentioned, between the budget, operational income and expenses, resulting in a first semester deficit. We have an investment budget, which includes the buying and selling of assets. Here, you can see the negative operational budget, while the investment budget is positive, meaning there are greater sales than purchases of assets. Then we have long-term financing. In this case, we did have financing, which results in a surplus, but not enough, because in this case, you will see that the first 3 months show a cash deficit. Therefore, in this model, what we do is seek financing for that deficit. It is not going to reach zero. It will reach the minimum balance of CAFE, which implies using credit lines for a few months. And of course, those lines of credit are paid off, but they also generate interest, which is what is shown in this second table. And with that, we will also be able to make a projection of the company's income statement. Note, for example, that the operational result is positive, even though the operational cash flow was negative. That happens, right? It can perfectly happen in one period. So that's why it's not like someone says, okay, what do we do? Do we project the result or the cash flow? The answer is both, because they look at different things. Okay. And after that, we have the result of the exercise, the last line, which is also positive in this case. And then we finally have the projection of the balance sheet with the projection of the assets. And what we do is we make a projection of each of the items, and then we will have a projection of the liabilities and equity, and we will also project each of the items. And of course, the idea, obviously, it needs to balance. So you can see here that the total assets ended at $530,500 in the projection, which matches the projection of total liabilities and equity. Now, we need to be careful, right? Because they are not always going to match up. They are not always going to fit. If they do not fit in the projection, it means there is definitely an error. And therefore, we need to see where the error is or, unfortunately, start fresh. Now, on the other hand, if it adds up, it doesn't mean that everything is perfect. It could be accurate, but with some errors, however, it usually indicates this in the projection. And another important thing here is that there is an order, and the order is what is here. First, the cash flow or the cash budget. Secondly, the income statement. And thirdly and finally, the balance sheet. That is the only path. Why? For example, imagine that we find there is an unfinanced cash deficit in the first 3 months. What do we have to do? Use a line of credit, take out a loan. If we use a line of credit or a loan, we will incur costs. Where do those costs affect? In the income statement and also in the balance sheet. So, there can be no other order than that of the cash budget, income statement, and balance sheet. If we change any of that, we are indeed going to have a significant or very significant problem when we look at our forecasting projection. So that is what we wanted to discuss with you about financial planning. And well, I hope that all the concepts we have been reviewing throughout the course, mainly concepts of financial accounting, financial analysis, and cost accounting, are clear. Costs and everything related to financial planning should be useful, not only from the perspective of this course, but more importantly, from the standpoint of your ability to make decisions. One does not have to dedicate themselves to doing analyses, crunching numbers, or handling accounting, but what is important is that these topics will always be present in any business and any organization. And if you are not in the financial area, at least you have the ability to understand the concepts, understand the tool and the model, and to be able to be a relevant and valid counterpart, because it often happens, right? The truth is that people from other areas do not understand this. They get lost, and many times they can contribute significantly to the discussion of various topics. And finally, from a personal point of view, of course, it is also very, very important. So I hope you are all doing well, and I hope this has seemed interesting and useful for your professional and personal life. and we will, of course, stay in touch.